Welcome to Chapter 5 of the Financial Accounting course. We're going to talk about inventories, merchandise inventory, and the cost of goods sold, COGS, which I introduced in Chapter 4. Another term for cost of goods sold is cost of sales. It's the same term. So I will record two parts of the video for this chapter. In the first part, I will talk about inventory basics and the core of this chapter, which are 4 inventory costing methods. We will cover specific ID or specific identification, FIFO, which stands for first in, first out, LIFO, which stands for last in, first out, and the weighted average method. And then the second part of the video will cover the rest of the chapter. So guys, first of all, the question is what should be included in the MI, in the merchandise inventory account? I want to remind you from chapter 4, merchandise inventory is a current asset and it's located on the balance sheet. This is also the inventory system we covered in chapter 4. It's very important to understand this simple diagram. And here, guys, you can see that we begin usually with inventory, right? It's a permanent account. Very few businesses begin with nothing left on their shelves. So we have the beginning inventory, which is actually, of course, the ending inventory from the previous period. We start making purchases in chapter 4. We talked about purchases, and then we call it net purchases because sometimes we have to add freight in and subtract purchase returns, allowances, and purchase discounts. Together, the beginning inventory and net purchases are called MAS, or merchandise available for sale. Everything I have to sell. Sometimes it's called goods available for sale, GAS. And then at the end of the period, whatever I sell goes on the income statement. That is cost of sales. That's an expense. Cost of goods sold. That's an expense account. Whatever I sell, I expense out. It goes on the income statement, and then I close it, right? So cost of goods sold is a temporary account, and so for the cost of goods sold, we actually are going to get rid of it at the end of the period. It's gone. The ending inventory, so this is the cost of goods sold, is the income statement account. I think it's on the next slide. But the ending inventory we keep, it's on the balance sheet, right? And then the ending inventory becomes beginning inventory, and we start everything again. I also want you to understand, we talked about it in chapter 4, these formulas and how to calculate each one of these 4 components. So to illustrate this, well, let me go forward for a second here. So the cost of inventory on hand is the current asset on the balance sheet. So merchandise inventory is the permanent account current asset located on the balance sheet. COGS, or cost of goods sold, is an expense on the income statement. So I want you to open this problem 5-1A. I'm going to also go to the textbook. Instead of lecturing a lot, I just want us to complete this problem together. And I have a printout for this problem. So I will be using this printout right here. And I also have instructions right here. So problem set A, it's on page 265, small numbers, page 265. So, by the way, there are 2 ways of counting inventory methods, perpetual and periodic. Periodic is covered in the appendix for this chapter, and you do not need to study it. You're not going to be tested on periodic inventory. We're only going to see perpetual. So Warner Woods Company uses perpetual inventory system. It entered into the following purchases and sales transactions for March. So this is 1 month. And guys, in parentheses, they give us information for specific ID. I will skip it for now. So look at what's going on, and let's relate it to this slide. Right? So beginning inventory, what do I have in the beginning inventory? Well, my beginning inventory, and guys, here in this problem and throughout the chapter, for simplicity, we assume we're carrying 1 item only. There's only 1 item. And the only thing here is that that item that we buy, its cost is going up, right? It's the focus here not as much on sales price. We're not going to pay much attention until later. This is how much we charge for this item when we sell it. We're focusing right now on cost, how much we're paying for this item. And guys, here I can see right away, it's an example of inflation, right? With time, the cost that I'm paying for this item is going up. Or sometimes in some problems you could see deflation where the cost per unit will go down. Here it goes up. So what's my beginning inventory? So I have 100 units at $50, right? So my beginning inventory is $5,000. So right here, my beginning inventory, I have 100 items at, let me go for a second here. I have 100 items at $50 or $5,000 beginning inventory. Net purchases, I'm not going to summarize right now, but you can see, ignore sales. We made purchases 1, 2, 3 times, and we bought 400 plus 120 plus 200. So we bought 720 units. So we bought 720 units at different costs. So guys, together my merchandise available for sales is 820 units. So I had 100 units, I bought additional 720, and then my merchandise available for sale is 820 units at a certain cost. Also guys, right here I can see how many items I sold. I sold 580 units, right? So if let me go right here. If I sold, so I had 820 units and I sold 580, then what is my ending inventory? It's 240 units, right? So right here, I can say 240, 580. So I sold 580 again, and I keep 240. Okay, so I hope it makes sense. Let me answer a couple of questions in this problem. So again, the problem asks the questions. I also have the same questions on the printout. Compute the cost of goods available for sale or merchandise available for sale and the number of units available for sale, right? So the units available for sale I already know right here, 820. The cost, total cost of merchandise available for sale, I'm going to multiply all of this together and add it up, and it will give me the cost. So here I have the same question. So what's the cost of goods available for sale? Here we go. It's the beginning inventory, $5,000. I want to remind you, this is, so what we had 100 items at $50 each. That was given. And we add 41,000. Let me make it a little brighter. Let me choose a different blue color. Here we go. And what I purchased is 41,600 from 3 purchases, right? Or here I can show you. I'm just going again to take all of these purchases and multiply them together. Well, I'm not good. You can do it. And it will result in $41,600. So together it's $46,600. That does not change. 46. So right here I can say it's $46,600, right here. Now I think of this as an anchor. This amount will not change. So this amount will remain the same. And guys, I don't need to really calculate separately ending inventory and cost of goods sold. If I know cost of goods sold, then I just take mass, subtract cost of goods sold, I get ending inventory, and vice versa. So mass minus ending inventory is your COGS. So again, let me put these amounts here. So beginning inventory is $50,000. So we just have it. Here we go. And net purchases from 3 purchases is 41,600. 41,600. I'll put it right here. 41,600. There you go. Now, the question of this chapter is how much of this total cost is assigned to cost of goods sold and how much we keep. Because if you look at the items, right, it's the same item, but which ones do I sell first and which ones do I keep? Depending on my method, the results, the balances of the accounts will be different. So how I distribute this amount will be different. How I split it between two accounts. So sometimes your ending inventory is going to be higher, sometimes lower. And that will impact your balance sheet, and that will also impact your current ratio. So if you analyze the company without, like, one company is using FIFO and another company is using LIFO, you shouldn't be really comparing those two companies' financials, because you're comparing apples and oranges. And again, COGS, if COGS is high, that means my gross profit is lower. And if gross profit is lower, that means my net profit is lower. I'm getting all excited here. And if my net profit is lower, I do not look as attractive to my investors, but I'm paying less in taxes. Versus if I have a COGS which is lower, I will have a higher profit, which looks great, but at the same time, I will have to pay higher taxes. So that's pretty much the issue in this chapter. And it's an accounting, the GAAP allows us to use any of the four methods I will describe. So guys, before I go back to the problem, let me talk about value in inventories. So, as I mentioned, you can use either perpetual or periodic inventory. We will use perpetual. Which items to include in inventory, I'm going to talk about it. Which costs to include in inventory, and which costing method to use. So these are four basic questions. Again, if your company doesn't have any inventory, if you're a Facebook, you don't care about this part of accounting. It only relates to companies that have inventories. Okay, so which items do I include? Which items do I exclude? Your textbook talks about, merchandise inventory includes everything that we own or hold for sale, regardless of where it is located, right? So if it's goods in transit, it depends on FOB that we talked about in chapter 4. If it's FOB shipping point, I exclude. I do not include goods in transit. But if my merchandise is FOB destination, I'm good, and the goods might be in transit for a few weeks. They are not physically in my location, but I do include them in my inventory until they get to the destination. Goods on consignment, you make jewelry, you place it, you're a consigner, you place it with a retail store, but it's your inventory. Even though it's in the store on consignment, it does not become the store's inventory until it's sold. And guys, we subtract goods damaged or obsolete. So there are all these different items here. We don't go into very much detail, but you need to know these three specific scenarios. So goods in transit we talked about in chapter 4. Now, the next question, so let me go back here. So I answered the question 1 and question 2. Now let's talk about, well, which cost do I include in inventory? So you go to buy a new car at the car dealership, and they always show you cost. If they don't, you should ask them, right? So what costs of that car are included? It's not just the purchase price. It's not just how much the car was manufactured for. It's also insurance, storage, freight, it depending on FOB, and import duties. So this is the rule. We must include all expenditures, this is the key word, necessary to bring an item to a sellable condition and location. So if I'm a car dealership and I have to pay for transportation, for freight, if I don't pay for freight, I cannot sell the car. So the freight is not an expense. We talked about it in chapter 4. The freight is included in the cost of inventory. Import duties. If I'm importing a car from Japan, I cannot get the car to the car dealership in the United States unless I pay the import duties. So import duties is not an expense, right? It doesn't go on the income statement. There is no such account as import duties expense. It's just included on the current asset with the current asset called inventory, and it's on the balance sheet. Versus, you need to repair something is broken, or you need to pay salaries. That's not necessary to bring the car to the sellable condition and location. Or advertising. It's helpful to spend money on advertising, but it's not necessary. So advertising and salaries will be expensed out. They will be expenses. They will not be included in the cost of inventory. So let's go to this page 259. Page 259, quick study 5-2, page 259, Quick study 5-2. I think I have it ready right here. Okay. A car dealer acquires a used car for 14,000 terms FOB shipping point. So we, the car dealer, the buyer, have to pay for freight. Under FOB shipping point, the buyer pays for freight and which is transportation, as well as for insurance while in transit. Additional costs in obtaining and offering the car for sale include, here are examples, we have to classify them. So which ones will be part of merchandise inventory cost and go to the balance sheet versus which ones will be directly right away expensed, meaning they're not necessary. They are not necessary to bring our car to a sellable condition and location. And very simple, so cost of the car, yes, it's included in the inventory. Transportation in, yes, or freight in. Oops, this is wrong. It's included in the inventory. Import duties of 900, yes. If we don't pay import duties, we don't have the car in our dealership. Insurance during shipment, yes, that's included in the cost of inventory. Advertising, not necessary, expensed out, goes on the income statement. Sales staff salaries, that's an expense. So here you go. So even though the car's cost is 14,000, I have to account for the car's cost, which will impact my gross profit and net profit at 15,450. So that's the cost. Then you make your markup, add your markup, and then you have your selling price, and you start negotiating with the potential customer. Okay. So the last question here is the most important one. Which costing method to use? As I said, we have a choice of 4 methods. We can use any of them. And by the way, GAAP allows companies to use different methods for different types of inventory. So if I'm a grocery store, I might be using FIFO for produce, but I'm using LIFO for dairy or for meat products. One thing I want to mention is that the international standards, IFRS, does not allow companies to use LIFO. LIFO is used only in the United States, which creates problems for international companies. So if the company uses LIFO in the United States but has foreign operations, they have to use a different method. And so when they combine their financial statements from different foreign market and domestic market, they have to change everything to one method that is acceptable in the country where they list their stock. Okay, so these are the 4 methods. As I I mentioned that the choice of the costing method will impact my profit, my taxes, and my ratios. And the most popular method is FIFO. The second most popular is LIFO. Weighted average is right here, and specific identification is right there. And guys, these are kind of highlights of each method. So let's go back to problem 5-1A. And again, this problem is on page 265. And let's go over FIFO first. First in, first out, right? So if you think about dairy and you go to the grocery store, they push the older items to be picked up first. First in, first out means I'm going to sell older items first. Whatever I bought first, I will sell it first. So if I'm selling older items first, in the example of this problem, if I sell older items first, they're cheaper items. So my cost of goods sold will be lower. And I'm keeping newer items. So if I sell older items first, that means I am keeping in my inventory newer, more current, more expensive items. So my merchandise inventory will be higher, my current assets will be higher, my current ratio will be higher, my profit will be lower, which means my taxes will be lower. So this is the idea. Okay. Oh, I didn't finish here. So how many units do we have available for sale? It's right here. We have 820 units. So let me fill this in. 820 units. There we go. Compute the number of units in ending inventory. I already talked about it. So we have 820 units. We sell 580. It's given right here. So we just subtract 580 from 820, and it tells you that we have 240 units sold. I'm sorry, kept, not sold. In engine inventory, But the question is, which ones, right? Which ones do we keep? Okay, so I set it up as a table. Number 3, compute the cost assigned to the engine inventory using FIFO. So March 1st, this is my inventory balance. Look at the columns. What we purchase, what we sell, and what we keep on the shelves. On March 5th, I buy a new layer of inventory. We call it layers. So this is my old layer coming from the previous period, previous months. I add on the bottom newer layer. I bought 400 items at $55. Guys, we only include costs here. We do not care about price. On March 9th, I sell 420 units. Ignore this price. The question is, which 420 units, right? So I have to sell FIFO, first in, first out. So I start with the top layer. So I'm selling 420 items. Which ones? I sell all 100 old items, and I sell 320 of the newer items. So how many of the $55 items do I have left? I have 80 items left. 400 minus 320 equals to 80. By the way, guys, my physical flow and my accounting flow of inventory don't have to coincide. It doesn't matter how I physically actually sell it in the store. It doesn't have to coincide with what I use on my books, which method I use. Okay, March 18th, I add another layer. 120 items at $60. March 25th, I add yet another layer, 200 items at 62. On March 29th, I have a second sale. I am selling 160 units. Again, the question is, which ones? I'm selling 160 units. I start with the top. So I sell all $55 items, and I sell 120, 80 of the $60 items. So what's left? 120 minus 80. 40 of $60 items are left, and all of the $62 items left, right? And so cost of goods sold, I'm going to take these four amounts, add them together. It gives me the cost of goods sold. Here you go. Well, I use blue too. Guys, I don't even have to calculate inventory. Remember, I can simply, let me go back right here. I can simply take my merchandise available for sale, 46,600. Let me do it, 46,600. And I'm going to subtract, I already have cost of goods sold. So let me subtract 31,800. That gives you engine inventory. So it's $14,800. You can double check. So it's what's left. 2,400 plus 12,400, which is 14,800. And so guys, again, I have COGS plus engine inventory equals to my mass. Hope it makes sense. First in, first out. So under first in, my COGS is lower, right? My COGS is lower because I'm selling older, cheaper items. If we have inflation, if we have deflation, everything changes. So under FIFO, my COGS is lower, which means my gross profit and net profit are higher. I'm giving you a second to think about it, right? If cost of goods sold is lower, that means my gross profit and net profit higher, which is a positive of using this method. But when your net income is higher, that means your taxes are higher, and that's the biggest disadvantage. Under FIFO, your ending inventory, which is your current asset, is higher because I am keeping newer, more expensive items, which results in a better current ratio. Okay, LIFO is the next method, and here we switch. We sell newer items first, last in, first out. An example would be, if you fly on an airplane and you check in your luggage, and then guys, you arrive to your destination and you're getting your luggage back. Usually the luggage follows this pattern. Last in, whatever they put last into the airplane comes first out. Last in, first out. So under this method, I'm going to sell, my cost of goods sold will be higher, and my ending inventory will be lower. So under LIFO, my cost of goods sold is higher, which means my gross profit, net income are lower, negative, but the biggest advantage, I'm paying less in taxes. And by the way, in the 1980s, General Motors switched from FIFO to LIFO and saved $380 million just in taxes, just because they moved from one accounting method to another. Okay, same idea, same layers. March 9th, we're selling 420 items. Which items? Start from the bottom, right? So under FIFO, we started with $50 items. Under LIFO, we're going to start with the $55 items. So we're going to sell all of them, this layer, and then out of the older items, we're just going to sell 20. By the way, under LIFO, your top, your oldest layer never gets completely sold unless you sell everything. Okay, I buy another layer. Oh, what's left? So I have 80 of $50 items left. And then I buy another layer, and then I buy another layer, and then I sell here 160 items, and the question is which ones? I start from the bottom, so all of the items that I sell are $62 items. And what do I have left? This is what I have left. So that older 80 items, they're, not sold. And guys, same thing here. Let's calculate COGS. Let's calculate ending inventory. My math doesn't change, but compare COGS. So we had a COGS of 31,800. Now it's 32,920. Let me go right away to this part right here. Prepare the income statement for each of the 4 costing methods in part 3. Assume expenses are 10,000 and the corporate tax rate is 30%. So sales, how do I calculate sales? I just simply take right here, I use the price. So I take 420 units multiplied by $85. That's my selling price. Plus 160 at $95. And guys, the sales, the amount of sales does not change. It doesn't matter which method I use. It's always going to be $50. I'm sorry, $50,900. Oops, for some reason, okay, there you go. Less cost of goods sold. So we already done FIFO and LIFO, right? So under FIFO, I'm going to take 31,800, and under LIFO, I'm going to take 32,920. So then my gross profit is higher under FIFO. Operating expenses are the same, 10,000. So these are your operating expenses, not COGS. And so NIBIT, which is net income before taxes, as you can see, is higher under FIFO, which is positive. But then we're going to subtract 30% of that, which is income tax. You can see my income taxes are higher. So LIFO's advantage is the lowest income taxes. Imagine if it's not thousands, if it's in millions, right? And then net income after taxes is, of course, more, is higher under FIFO. Guys, again, if an example includes deflation, then everything changes. Then FIFO offers you biggest tax advantage, and LIFO offers you the highest net income. Okay, some companies argue, almost done here, guys. Some companies argue, I don't want to use very high or very low method. I want to use weighted average method to smooth out the differences. This is the formula. It's a very simple formula, but students somehow have problem with it. They get FIFO, LIFO here. Some students get confused. Weighted average cost per unit. This is the formula. Take total cost, divide by total units. So when I sell 420 items right here, before I sell them, I need to calculate my weighted average cost per unit. And I will assume I don't have, $50 items and $55 items. I just have to calculate some weighted average. And weighted, if I have more items of $55, my weighted average will be closer to 55 than 50. What's the formula? Total cost. What is your total cost? 27,000 divided by total units. What's your total units? 500. So here you go. Weighted average total cost by total items, $54. So now I sell all of my items and I assume they're all $54 each. What do I have left? I have 80 items at $54 left. I buy another layer, I buy another layer. I mean, by rules, I have to recalculate weighted average after each layer, but it's not really, it doesn't change anything. So I will calculate weighted average just before the next sale. Again, total cost, I add these three items, not items, amounts. It gives me 23,920. I have 400 items. This is my weighted average. Some items are $54, $60, $62. Now I assume all of them are $59.80. And so when I sell 160 items, that is the amount of cost of goods sold I have, and this is the amount of inventory I have left. So I'll put it right here. You can see your COGS plus ending inventory equals to the same anchor or merchandise available for sale. So let me just take this 32,248 and fill this right in here. So you can see that your COGS under weighted average is not as high, is not as low. So your gross profit is in the middle, and then your net income before taxes, and net income after taxes are not as high, not as low. Guys, for specific ID, we will use specific ID only for types of merchandise that is very unique, and you can really specifically identify each item you sell. You know, usually if you sell antique cars or customized houses or anything really expensive, customized jewelry, you might be using specific identification. So the problem has to tell you which items are sold. So if I look right here, it says for specific identification, the March 9th sale consists of 80 units from beginning inventory, 340 units from the March 5th purchase. So there's no logic. They tell you 80 units and 340 units. So right here, this is where I take this information. So I'm setting 420 units, and out of those 420 units, 80 units, let me make sure, 80 units are at $50, and then I'm not going to calculate just to make it faster, and then 340 units are at $55. So guys, you calculate here. I just want to go faster, and we keep going, you know, in the same manner. And for March 29th, again, they tell you which items you sell. So I'm not going to fill out the rest of this. Now, with the specific identification, I do ask you to do it in your homework, but I'm not going to include it on the test as a separate problem because it's a rare method. It's not used as much. Okay, let me come back here and finish up. Okay, so we've used all four methods. And guys, we completed, except for specific identification, we completed with you a different example. These are different amounts, right? We completed, you can see the impact of different costing method on financial statements. So guys, what I want to conclude with, as I said, you know, each method has its advantages. Guys, FIFO, this is kind of fancy. What we have left, what we did not sell, my inventory is newer. So it approximates the current replacement cost. The items that I keep in my inventory are the items that I bought recently. So my value of the ending inventory is similar to what I would have paid to buy those items again right now. Last in, first out better matches current cost in cost of goods sold with revenues. Why do they say it? Because you sell more current items. So your COGS is more current. And weighted average smoothes out price changes. So let's go to page 261 and let's take a look at the last quick study for this part of the video. Quick study 5-18. Okay, here we go. So identify the inventory costing method best described by each of the following separate statements. Assume inflation. A period of increasing cost is inflation. Which method yields a balance sheet inventory amount often markedly less than its replacement cost, right? Which method, balance sheet, inventory, keeps items that are old. Old items are kept. And it's, of course, LIFO. So again, the language here is a little difficult. Think about it, because you will be asked questions like that on the quiz and the test. Which method results in a balance sheet inventory amount approximating replacement cost? So we talked about it, right? And it's FIFO. Again, think about it. Make sure you understand it. Balance sheet inventory is what I did not sell. In which method do I keep more recent items in inventory? And it's FIFO. I sell old items, I keep newer items. Which provides a tax advantage deferral. By the way, it's not like we are not paying taxes. We're going to pay them later. So it's called deferral. To a corporation when costs are rising, and it's LIFO. Right? LIFO gives the tax advantage. Which one recognizes matches recent cost against net sales? That's the same phrase as what we have right here. Better matches current costs in COGS with revenues. It's the same idea, and it is LIFO. And the last one, the preferred method when each unit of product has unique features that markedly affect costs, and that's specific identification. Okay, so couple more items before I conclude this video. So the tax effects, guys, you can read it right here. I mean, if I had a choice, each company, each corporation has two sets of books. They have a set of book for financial reporting, and that's what we are studying. And they have a different set of books for taxes for the IRS. And guys, the approaches are often different. So if I had a choice, I would use LIFO for taxes, and I would use FIFO for financial reporting because it gives me the highest net income. But the IRS says if you're using LIFO for tax purposes, you must use LIFO also for financial reporting. Guys, the consistency concept. Can I change the method? Yes, you can, but not more often than once in 10 years. So the companies are required by GAAP to consistently use the same inventory method from a period to a period. And if you decide to change it, you have to notify the IRS, and you have to recalculate the difference in methods in your annual statement from the beginning of the company. If your company has been in existence for 100 years, you have to recalculate all your incomes. You were using FIFO, now you're using LIFO, and you have to show the difference, add up all those 100 years net incomes and show the difference. And you also you must have a reasonable explanation. You cannot say, I'm changing, from FIFO to LIFO because I want to save in taxes. But you can say, I have international operations where I am not allowed to use LIFO, so I'm changing from LIFO to FIFO in my United States operations, so that my operations all over the globe use the same inventory method. And also, guys, the disclosure concept. If you go to financial statements, you will, in the notes to the financial statements, you can read which method or methods of inventory costing each company uses. Okay, thank you for your attention, and I will cover the rest of the chapter in the second part of the video.